Chapter 4, The Old King, Why Gold Lost the Throne. In Chapter 3, we saw Bitcoin declare independence from the Nasdaq through a structural inversion of correlation. Now we address the most important question of the rotation: why Bitcoin and not gold? For thousands of years, gold was the undisputed king of safety, the final refuge for global capital. But between 2025 and 2026, the PDF describes a historic change. During a period of macroeconomic stress, capital did not flee to the old king. Instead, it flowed into a digital asset barely 15 years old. Gold's weakness was not presented as a sudden event. The analysis describes it as the conclusion of a long cycle that was already ending before Bitcoin began its ascent. To understand the rotation, we first examine gold's own macro structure through the GLD exchange-traded fund. The 8-year GLD analysis identifies 3 major stages. From 2018 to 2020 came accumulation and expansion, culminating in a Phase 3 climax during the pandemic. Late 2020 through 2023 brought a Phase 4 reset and reaccumulation. Then 2024 to 2025 delivered a final bull wave marked by distribution. During that final gold wave, price pushed toward new highs while the underlying demand ratio consistently failed. The PDF identifies this as a bearish divergence and concludes that gold entered the 2026 stress period with profound internal weakness. Gold was not weak because Bitcoin was strong. Gold was weak because its own cyclical engine was already out of fuel. The long cycle chart makes the argument visible. The surface price and internal demand did not move with equal strength. The late cycle distribution pattern weakened gold's position before the rotation became obvious. The divergence became undeniable in the 2025 head-to-head comparison. Both assets rose in price, but the quality and force behind their rallies were very different. The question was no longer simply which asset went up. It was which asset attracted stronger underlying conviction. The PDF reports that gold's price increased by 48.5%, driven by demand ratio growth of 32.3%. Bitcoin's price increased by 28.8%, while its demand ratio exploded by 62.3%. This is the quantitative contrast in energy and conviction. The analysis then turns to the asset's properties. Bitcoin offers absolute program scarcity, transparent inventory, instant global transferability, digital verification through mathematics, and modern utility as both a store of value and a programmable settlement network. Gold remains valuable, but these digital properties change the competitive landscape. The 5 comparison points are absolute scarcity, transparent inventory, global transferability, digital verification, and modern utility. Together, they explain why a new generation of capital may evaluate safety differently in a digital age. The PDF's verdict is not that gold has no value. Gold is still respected and still valuable. The conclusion is that its role as the default safe haven is being challenged. In the mid-2026 stress period, the old king stagnated, while Bitcoin rallied. The throne was not taken violently, it was taken mathematically. To recap, gold entered the rotation with a weakening cycle, Bitcoin showed stronger underlying demand, and digital properties gave it new advantages. In Chapter 5, we ask what makes Bitcoin a commodity and define the commodity framework. This conversation is for educational purposes only and not financial advice. Past performance does not guarantee future results, and investing involves risk. This is an invitation to learn, not a recommendation to invest.